Towards the end of Alfred Hitchcock's The Birds, enough feathered weirdness has happened to convince an audience that textbook rules of nature no longer apply. Tokyo markets are doing something similar, but with more expensive special effects. With just 2 months left in 2016, companies have spent a record 4 trillion yen buying their own shares and cancelled a record 3 trillion yen of them. The central bank purchase rate of exchange-traded funds has risen to a record 6 trillion yen a year, and a record 55% of non-financial companies in the Topix index hold more cash than interest-bearing debt. Some calculating that Japan's government pension investment fund has some 5 trillion yen of Japanese equity purchases left to do in order to balance its portfolio, see clear buy signals here. But into all of this, another record. Just as the lead characters of The Birds decide to sidle gingerly into the sunset rather than stay and work out what's going on, foreign investors ditched a record 6 trillion yen of Japanese shares in the first 9 months of the year. In the early stages, the sell-off seemed to be driven by oil-backed sovereign wealth funds taking profits. The theory worked well when crude was $35 a barrel, less so as it hovers as it does now, around $50. So why have all these market catalysts, along with Japan's cheapness compared to Europe and the US, not served as foreigner bait? One answer is that those much fan-fed market drivers are themselves leaving investors cold. Between their buying strategies, Japanese companies, the Bank of Japan and the GPIF are handsomely offsetting the foreign pullback. They are doing so, though, in a way that many global funds see as destructive to the overall pricing mechanism of the Tokyo market. When foreign buying was rising to its peak between mid-2013 and mid-2015, the non-Japanese funds were 60 to 70% of daily market turnover. For every foreign fund that went overweight Japan during that time, there was a comfort that came with being a fin on the biggest whale. A crueler answer, though, is that global funds need their narratives on Japan to be unnuanced. And as matters stand, the story is resistant to neat packaging. Abenomics as a concept may not have failed, but as a broker's rallying cry, it is much tattier than it was before, and certainly too fiddly for the bird-brained.